Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And he's back, guys. Today we had, I believe, by views, the most popular guest to date, Mr. Shubham Garg, White Tundra investments, oil expert. And we are here today to talk about the oil market, what's happened, what hasn't happened, and much more, some of the exciting things that he's been up to. Before we get in, guys, just a bit of housekeeping. Nothing we discuss here is advice, is simply our opinions and what we are potentially doing with the funds that we're in charge of. So you are responsible for doing your own due diligence. Having said that, Shubham, welcome back. It's a pleasure to have you. How are you, sir?
Good. It's good to be back, Ben. We appreciated the last chat, so it's nice to be back, and always happy to chat oil, I think, as some of the viewers know. So
absolutely.
Yeah,
It's the last one was a chat for the diehards. If you haven't seen that episode, guys, it's on the YouTube channel. 2 hours of an absolute masterclass going from macro all the way down to micro views on certain companies and how Shubham views the world. Now, oil has been down 5.5% year to date. Some people are biting their fingernails. They're worried. We said there was going to be an oil party. And so my first question to you today is, do you feel like the party's been cancelled, or it's just a bit of rainy weather and they've just kind of postponed it for another weekend?
Yeah, so using that analogy, I would say the party has been delayed for sure. But the way that the oil party works, and this is me going back a little bit now, talking to somebody who's been waiting for the oil party almost a decade at this point, that every time the oil party gets delayed, when the party does end up happening, there's way more booze, there's way more people, and there's way more money being thrown around. So it's a matter of, and we'll get into this, we'll get into supply demand, but the longer oil stays below, call it certain thresholds, which are about $80, $85 a barrel, the more that supply continues to get hit. And I can talk about some data as we go on that proves that, and the more that demand continues to go up. It's just the nature of the way that a commodity works. So there's been a few factors that have held up the call it oil party for many months now. The SPR, the Russian barrels, Chinese demand, and lockdowns. But we've had movement on pretty much all three fronts, which were the major fronts that we were looking for in 2022. It didn't quite happen. Now we go into this year with some major news on all three, and we'll let it play out over time. In the meantime, nothing's really changed. They haven't fixed anything. They haven't fixed supply. And demand has not suddenly cratered as certain people thought it would, in the way that the global interest rates and the Fed funds rates have been hiked, over the last 12 months, let's say.
Yeah, absolutely. Now, you mentioned those three factors, which we mentioned in our last discussion, and many other people have been watching. Out of those three, is there anything that surprised you? Have you been surprised by the amount of Russian crude that has somehow been able to continue coming onto the market? Or has it been more, oh, I thought China was going to open earlier, but they continue to have suppressed demand due to COVID lockdowns? Has there been anything in particular that surprised you out of all that?
Yeah, I would say all of them. So on the Russian barrel front, the fact that they've been able to maintain production, and then also Siberia had one of the coldest winters ever, which is where a lot of the oil and gas facilities are, but they were still able to maintain their production, at least so far is what it's looking like, has been quite a commendable job. They did it obviously with a skeleton crew of service companies. They did it with not the same level of support. Keep in mind, a lot of Russian revenues into the government are going into their military at this point. So they don't have the same dollars to pump back into CapEx either. And this is a country that has previously publicly said that, look, our fields are high cost per barrel fields. So the fact that they're willing to keep these fields going, despite the lower pricing and then the further discount on the Urals grade and even the ESPO grade is quite interesting just from a psychological perspective. But they finally made a statement there a couple of weeks ago that they will be shutting off about 500,000 barrels per day We'll see how it plays out over the next kind of month, 2, 3, 6 months. What exactly do they shut down? Is it crude? Is it diesel? So we'll find that out. The one thing to keep in mind with Russia is that when we look at a supply and undersupplied bull market in oil, the thing that causes problems is more supply. So the bull is always looking for where can the supply come online from. In the 2000s, it was conventional oil, your big oil sand, a conventional oil offshore. In the 2010 to 2014 era, it was your oil sand projects. It was Iraq, it was Kazakhstan. And then from 2014 onwards, it was shale that came online with these millions of barrels per day. Now, when we look at the future, there are only a few countries that can increase supply to that standpoint. And Russia was one of them. We no longer see that. So over a mid to long-term perspective, it is nice that one of the major countries that could have created that bold thesis by adding millions of barrels over a multi-year period is no longer on the stage. So there's a short-term view on Russia, and then there's a mid to long-term view on Russia. Now, when we talk about China, I'm actually surprised the other way, where I thought the opening was going to be slow and steady. You're going to see it on the consumer side. People are going to be deathly scared of the virus, given kind of this mentality that the Chinese people are under this communist regime and whatnot. But we're really not seeing that. We're seeing statistics like people who are attending theaters are at all-time highs. So people would not be locked down for 3 hours in these claustrophobic areas if they were scared of the virus. Domestic flights are almost at all-time highs. International flights are ramping up. So the consumer data is looking really good. I believe the government just a couple of days ago claimed victory over the virus, and they've also completely taken down their red, yellow, green app system, which is very shocking to me. I thought they would want to maintain as much control on the population as possible, but they're just like, you know what, we need our economy running. Let's go. And a bunch of stimulus happening. There's about $2 trillion of money that the citizens have saved up that's going to come back. And the next thing I'm watching for is the non-consumer activity to ramp up. So your industrial, property, manufacturing, and that always has a couple of month leg to it. People have to go into the country, make business deals, decide on supply agreements, and then these factories fire up. So there's a bit of a lag there. And the kicker on the can that people are missing is China is adding about 500,000 barrels per day of petrochemical feedstock demand this year. So there's an additional 500,000 barrels per day of that demand that's going to eat into your propane butane market, which is really things that people just ignore for some reason. These sorts of demand increases, but the petrochemical market is absolutely on fire as far as feedstock demand over the next 2 to 3 years.
Fantastic. So we've got, well, they'll be getting a good deal on gas prices at the moment, I would assume, given they've fallen off a cliff. But if you've got, okay, so would you suggest Russia tried to front load as much of its production as it could because it knew it was on the blacklist? They knew that they were reliant on foreign intellectual capital, so workers coming into Russia that are no longer allowed to work there. So they pumped out as much as they could. Now we're expecting maybe a drop of, call it 500,000 a day, and then China's picking up by 500,000 a day. So we've got this million barrel swing. And then what's going to happen with this bloody SPR? So we figured that the SPR was going to be done by US elections. It had served its, call it, political purpose, but it's like the zombie that just sticks its hand out of the grave and continues to claw back. How much more can they release at what rates? And does it even matter?
Yeah, so the SPR release of 26 million for 2023 is something that was in mandated congressional sales. So it's not something that came completely out of the blue. However, the consensus was that because the Republicans in America had won the House and there was this split party political system, that the Republicans would cancel the SPR sale in exchange for maybe increasing the debt ceiling or giving up some other part of the call it system. So that obviously did happen. We are not entirely sure why $79 a barrel is by no means an emergency, that they should have followed up on these releases. And I think there was a secondary thinking that, hey, if the Democrats use the SPR for their political benefit in 2022, now they would want to save it for 2024 as opposed to use it in 2023. So it is a bit bizarre to me. The volume, 26 million barrels, not obviously as big as it was last year. If we go back and look at what oil price did last year on the initial SPR sales, not the 180 million barrel, but the 20, 40, 70 million that they did earlier, it did not have much of an impact. By the time we got to June, we were already in the 180 million barrel, 1 million barrel per day sales. So the initial multi-million barrel sales didn't make that much of an impact. So we'll see if that's the same this year. I'm obviously running with that kind of mentality that, hey, it's 250,000 barrels per day for a 3-month period. We have to take that into account, but on a global scale, it's 0.25% of global demand. So, more coming onto the market. I believe there's about 15 million of exchange barrels that have to go back into the SPR as well. So that's going to take away from the physical market. Again, 15 million is not a huge number, but there's kind of a swap that's also happening. And then I think 2024, there's another 26 million of congressionally mandated sales. And I should check this data as well. But that's going to bring us down to the level they had congressionally mandated all the way to the end of the decade. So we'll be at about 325 million barrels. And then that's the new level they wanted to stay at. Now, the one thing that's happened behind the scenes is when the Inflation Reduction Act happened in the US, the US government actually took, I believe it's about 120 million barrels worth of the 180 million barrels sale. They took that money from the Department of Energy. So the DOE no longer has the money to buy back the level of barrels that people say, okay, well, they're going to refill the SPR to 700. Well, the DOE doesn't have the money. It got taken away by the US government. So by my calculations, the max that the US government can buy, or that the DOE, Department of Energy, can buy back is probably somewhere around 50 to 60 million barrels at max. So I would not use the SPR buyback as a bullish factor. What I would take as a bullish factor is the SPR is 225 million barrels below what it was last year. So they can no longer give out that much oil this year or any year down the road, for that matter.
Okay, that's super fascinating. And when we're talking SPR, we're talking crude, correct? So where do you see with one factor that you've mentioned is that refinery maintenance was either neglected, delayed, or just didn't happen last year. Now we're coming into right now refinery maintenance season. Where do you see the opportunity in the near term? Is it with crude or is it more on the refined product side? I mean, if you're closing down your refinery, presumably they've been creating as much refined product as they can. They will use that until that starts to run out. But then when the refineries open again, they'll be wanting to increase their throughput, and the feedstock for that is crude, right? I'd be interested to get your comments around this phenomenon of refinery maintenance, given it didn't really happen last year.
Right. Yeah. No, this is a fascinating question, and one that kind of has taken more prevalence last year and now this year. We never even used to talk about refiners making money. They always operated at their cost of supply, I guess, and never really made any money, which is why you see that America has not been all that interested in buying refiners or building refineries, whatever, right? So now that we're in this, I think this year is going to be just a tiny bit different than last year. Last year, we had the refinery skip maintenance. We had a lot of refining not on the market still, given some of the issues that they were having, and the global demand for products just went through the roof. So this year, we do have a bit more products on the market. We have way less crude on the market. And the refinery maintenance has this whipsaw pattern where from February 1st to call it March 15th, there's even more refining maintenance, which means crack spreads could go further up. But once March 15th is done, you're not only getting the US refiners back online, you're getting a few refineries like Cenovus, Superior, and then Suncor's Commerce City as well. They're coming back after kind of shutdowns. And then also Kuwait's Al Zour is now fired up, 600,000+ barrels per day, if I'm not mistaken. And then you're also seeing some new refinery fire-ups in China, up to 1 million barrels per day. So because we have that new refining capacity, it's kind of unknown which is going to take over. If you believe in the oil bull market, let's say that crude is going to go up, I would expect that crack spreads are going to stay in the $25-$30 range as a minimum. But I don't see the same case unless there's some sort of late winter storm in the US or there's some major refining problems in China that we would see, or in Russia for that matter, because Russia is a pretty major refiner. Unless we see those problems, I don't see the same case for $50, $60 3-to-1 spreads that we saw last year. However, just keep in mind that refiners make a lot of money even at $25, $30 crack spreads. So if I was betting and I'll say, okay, which one would I put my money in? Obviously, it's going to be the E&Ps, just based on the way that I invest and the way that I see the risk reward around it. But when you're talking which part of the industry could go completely vertical in the case of refining problems, it would be the refinery part of the equation. Whereas if you said there's going to be 1 million barrels more of crude offline, okay, now crude can go up, yes, and it will go up, but it doesn't have that same percentage difference that 1 million or 2 of refining coming offline would make crack spreads just go through the roof. So that's kind of the way that I see it. And from my kind of risk reward models, I don't see a case to be made that multi-million barrels of refining could go offline, whereas I do see a case of the supply demand on crude could get so out of whack to bring up that that sort of increase in price that I think we're all investing in at this point.
Okay, that's very interesting. Now, you have mentioned a few things that I wanted to go into a little bit more in depth, that being calculating the break-even cost per barrel. And I would like, if we could, to kind of do a general overview of the regions of the world. So where are the high-cost producers? Where are the lower-cost producers? And then from there, we'll move into types of companies, be that you've mentioned already refiners. Do you like the fully vertically integrated companies? Offshore services, and then as a bit of a curveball, we'll talk about tankers. But we're talking $80 to $85 a barrel oil. What's the break even for most of the companies that you invest in on a per barrel basis? Let's start with that.
Sure, yeah. So I can kind of maybe phrase it a few different ways here. So sure, when we talk about break even, I think it's one of the most misleading terms, not because it doesn't mean anything, but because people skew the definition of break even to fit whatever company they're investing in.
This is so it depends on how far down the expense column you go to get this break even.
Yeah, they'll take certain things out. They're like, oh, we don't want to include acreage acquisition cost. We don't want to include interest. It's like, okay,
so you get your land for free.
Yeah, because that's how the world works, right? So I think there's a few things that I look at. I look at operating cost per barrel. So when a company already has existing production, what is the cost for them to operate that and bring that barrel to market? Now, that's important because when we're talking about, okay, oil prices can go down to this level, people are running their models. If somebody's already spent the CapEx to build the wells, build the infrastructure, build the pipelines, we cannot take that into account to what an existing field would shut on or off at. So
because the CapEx has already been spent, right?
Yeah, it's already been spent. The things have already been built. The quote unquote previous investors have already paid for that. So when I look at operating cost, the companies that I have in my portfolio, in the Canadian space, I'd probably say between $10 to $15 a barrel is where we are. There are some higher cost junior companies that I'm in that are in $20, $25 a barrel kind of mark for operating current existing production. Now, current existing production declines. So every oil well out there, 12 months down the road, is going to decline. And there is what we call a capital efficiency on that. So if we are going to have, let's just say for easy math, we have a 100,000 barrel per day producer, or let's go even smaller, let's go 1,000 barrel per day producer. It's operating at $15, $17 a barrel. Excuse me. The company decline rate, let's say, is 20%. So every 12 months, we need to replace 20 barrels per day or 200 barrels per day of production to keep our production profile flat. That 200 barrels per day, what is the capital efficiency on that? Like, how much new CapEx do I need to spend to make sure my production profile is flat? And there's certain companies that I invest in that are in the $6,000 to $8,000 a barrel range. So when we have, let's say, we need 200 barrels a day of new production, we just multiply that by $6,000 to $8,000 a barrel. That would be your CapEx program for the year. There are other producers like shale producers that are in the 10, 12, 15, 17,000 barrels or $1 per barrel to bring that online. And their decline rates are a lot higher. So they need a lot more dollars for the barrels to bring online. So these are kind of differentiating factors that I think any oil and gas investor should go into. You should look at what is your current operating expense per barrel. You should look at your decline rate, and you should look at your capital efficiency per barrel. So now that just talks about existing production. When we talk about full cycle break even, which includes acquisition costs or acreage acquisition costs, it includes G&A, it includes your any cost on interest on the debt that you have, your cost of capital per se. I would say a lot of them would be $35, $40 a barrel in the Canadian space is a good number to run with. That's sort of where they would completely cut off CapEx and just say, we're just going to produce what we have here. We're not going to put any money into the ground. So it's about a number that I run with. Yeah. And that would be what we call a full cycle break even cost.
Okay, and that's fully loaded expense sheet, including cost of capital, cost of CapEx, all that sort of stuff. Yeah. So call it maybe your investor worry point. If you see the commodity getting below that point, it's time to worry from that perspective.
Yes. Yeah.
And how does that compare to other players in the world? I know shale in the Permian is probably a little different because of the liquid to gas ratios we're starting to see. But in the developing world, how would that compare to somewhere down in where I am at the moment, say Latin America, Colombia, Brazil being the two main places that I'm thinking of? Do they have a cost advantage due to cheaper labor?
Yeah, so I don't know exactly what the break-even costs are in those areas, but I'm thinking they are roughly competitive with the Canadian play. The only things that are different when you talk about other places of the world is obviously the geopolitical risk, which is very subjective. I will say a lot of people try to make geopolitical risk an objective term. It's not. It's very subjective, and in a lot of cases may already be priced in to the equities that you're looking to buy. So from that standpoint, I think it's up to the value investor to figure out what makes sense from their own perspective. But the real big difference between break-even cost when you invest in a Petrobras versus a Canadian producer is the government take. So in a lot of these countries, even though your break-even cost per barrel, if you owned 100% of Petrobras, let's say, is in my opinion likely lower than the Canadian producers, when the government's taking so much of it, at the end of the day, you as an investor
need to add that into the cost per barrel essentially, because it's an expense that you're not
correct. Yes. So you do have to take that into account. I can tell you as a fact, there are wells that companies that I'm invested in that I'm drilling, or the companies that I'm invested in are drilling in Canada that are not going to pay any royalty dollar for their entire lifespan, which could be hundreds of thousands of barrels. So that's a cost advantage right there that is seriously significant versus some of these other producers. But some of these other producers that you're referring to trade at much lower multiples and valuations. So it eventually comes down to the individual investor and what they see kind of going forward.
Now, I don't know how the hell you manage that in Canada, but I tip my hat to you, sir. That's an excellent achievement. Now, you just mentioned multiples. I want to talk about some of the depressed valuations, particularly in the smaller cap sectors. How do you look at some of these companies if you're just going to invest? I know you're doing a lot more activist style investing, but are you prioritizing returning shareholder capital and you're wanting to get those dollars back as quickly as you can from dividends or buybacks? Or are you looking at saying, look, this company has just been smashed on its multiples, a reversion to mean is likely, and so you're going to make some money on an expected multiple increase? Or are you looking at companies that can value add and maybe make some really great acquisitions and get essentially a growth in earnings, growth in production, and whatever happens on the valuation happens? I'd be interested to see how you rank those in your own mind in a kind of a mental checklist.
Yeah, you bet. So when I look at small caps, and once again, the definition of a small cap may change from investor to investor, but when I look at some of the small caps, like junior companies that I'm looking to invest in, what I start with is the rock. The rock, as in the geology, has to be good, and it has to have oil. I'm not interested in taking on exploration risk to the significant manner anyway, where you're going and drilling somewhere brand new offshore, whatever, very expensive wells. I'm talking you already have a large area of undeveloped, relatively proved acreage. And this is where I think people get possibly caught up on reserves a bit too much. When a company says they have reserves, it only talks about areas where they've already drilled wells. But the way geology works is you don't have to drill a well to be 80, 90, 100% certain that there's oil there. So there's these underlying trends that you can identify on geologic maps, on seismic studies, on doing coring data that can tell you there's a lot more oil there than maybe what the reserves are showing. And the companies are already trading at 50% of their PDP, proved developed producing reserves. So when I see something like that, and I see more undeveloped potential in good rock with good wells, that's what I start with. And then what I look for is a management team that can execute to bring that value into the company and drive that share price up through execution of whether it's production growth, whether it's optimizations, whether they're bringing wells back online, they're implementing an enhanced oil recovery, possibly doing these things. And why I think that's really important is because there's a double whammy effect on some of these smaller companies. And what I mean by that is when you have production go up and you have oil prices rise, you not only get the benefit of WTI rising and the extra netback from that. What happens is as your field grows, your dollar cost, operating cost per barrel comes down significantly. So if I'm only
increased production, is that
100% massively, right? A lot of the costs in oil and gas are fixed costs. You have a compressor station that needs to be operated, that needs electricity, it needs engine oil, it needs all this, whether it's running at 10% capacity or 100% capacity. It's the same with oil batteries, where the oil battery could be processing 10% of capacity or 100%. You're paying the same guy to clean the snow off the road going in, no matter what. You're paying the cell phone bill or the telephone bill for that battery, no matter what. Like, these are small expenses, but it applies to all the fixed cost in the battery. So as the production rises, in some cases, production could rise 5x in some of these small companies in a matter of a year or two. So that drives down your operating cost per barrel, which then makes your net back increase a lot higher. So I do look for opportunities like that with good geology, with the management team that has the experience, and more as I go on, I'm really focused on management teams that are engineers and geologists I know maybe certain people are not going to like hearing that, because geologists also make up a lot of stuff, and they get super hyper focused on certain things. So do engineers. But
Accountants would never change what they report either, you know.
yeah, that's a different kind of hyper focus on a certain goal. But I just think that as the cycle goes on, oil is getting harder to find. The oil that we're extracting is using more and more latest technology. It needs nuance to it. It needs caveats to it. So I like teams that have that technical background, especially if they have multi-decades of that, because it is a dying art. A lot of people in the oil patch have retired. They have moved on to other industries, or they just don't want to deal with the cyclic nature of their paychecks. So they say, we're done with this. If you want us, then you got to pay us way more, or we're just not coming back. So given that, those are kind of the factors that I look at. I don't care much about shareholder returns. And the reason why I'll say that is just think about it from a investment standpoint, right? If I'm buying something at 2 times cash flow, 3 times cash flow, and management gives that money back to me as a dividend, do I think I can generate more than 2.5 times cash flow on that dollar? I don't think so, because if I did, I wouldn't have invested in the company in the first place, right? So in that sense, the company, use every dollar you can back in the ground. I'm also a bit more risk tolerant in that I actively tell my junior companies to go and secure debt, to go and get that financial leverage, use somebody else's money at 8 to 10% to drill wells that generate 150% IRRs for me on a full cycle basis in the first year. So these sorts of things, the oil patch has lost its, I think, aggressive mentality in a lot of ways because of capital markets, because of the lower for longer cycle that has happened. And I think that's where the opportunity is, where somebody can come in and really have a hyper aggressive growth plan. At the same time, you're buying companies at 2 times cash flow, so that the downside risk is a lot lower than maybe 2013, 2014, when the junior companies were themselves valued at 6, 8, 10 times cash flow. Now you get these people telling you, be careful, we lost money in 2014. Well, I understand, but you were also buying junior companies at 5 times the multiple that I'm buying it at, right? So these are some of the nuances that are less well understood, and people have this PTSD mentality that let me be honest with you. I had 3 companies go bankrupt on me from 2014 to 2016. So I'm not talking these things as a new entrant. I'm talking somebody who's gone through that, and I see why this time is different. And hey, if oil goes to $40, maybe I lose all my money. But if people have that in their models, why are you in the oil industry to begin with? Why are you investing, in this sector either way, if you believe that's a reasonable possibility here over the next, few months or year?
And I think that's a layered, nuanced, and structured, intelligent approach, because you have cash flow there to service. Presumably, if you're buying something, call it 2 times cash flow, 50% free cash flow yield, then if you can get a cost of capital for less, for 10% even, you're making that spread. And so in addition to that, you've got that kind of a call option on some unexplored acreage that the company owns. And so it's an intelligent way of covering your bases, covering your serviceability with that upside. It's not necessarily a 0 or 1 outcome.
Correct.
You have these multiple ways of winning, and you mentioned everything that I said in one answer. So that's a cracking answer. I love it. You mentioned PTSD, and that brought back very traumatic memories of the tanker and shipping markets. My least favorite, but I must admit I still do own some shipping stocks.
Yeah.
Are you interested in that space at all, particularly given this? And I know it's very high level macro, but geopolitical division. And so getting crude from point A to point B from, let's say, an unpopular nation, that's just going to result in increased ton miles, isn't it? And we've got these ship builds that are booked out till 2024, so that the supply is not likely to increase the fleet. Are you playing in that space at all, or you have any thoughts about tankers and shipping?
Yeah, you bet. So I think just before I get to that, I do want to highlight one thing on my investment strategy, because you mentioned the 0 and 1 thing, which I think is such a misconception that people have, is like, if you're buying junior companies, you're betting on a 0 or a 10x. It's like, no, the 0 possibility doesn't exist. So just take it out of the equation. And the way that I represent that visually is, think about a dot with an error bar on it, right? People are thinking that there's this dot right here, and this is the error bar, maybe like this, skewed upwards, but got this downside. I think that the error bar is more like this, where the downside is 10, 20, 30%, whereas the upside is even higher because you're getting in at 2 times cash flow. So it's the skewed error bar, which means your expected value distribution curve is all the way here as opposed to a normal distribution curve. So again, this is a concept that people will push back on me for. I think they'll say you're taking on unnecessarily higher risk. Your Sharpe ratio is through the roof, but it's only when you look into the companies that you realize what's actually happening. So, and now to your question about the tankers, I haven't honestly looked at most things except the E&Ps. I like to read the corporate presentations to understand what's happening. A lot of times you'll find that the service side subsectors of the oil and gas industry, their corporate presentations tell you a lot about what's happening on the E&P side. So I definitely read them as much as possible. There was a company, just for example, that was taking oil from the Petrobras offshore platforms, small tankers, and putting them onto bigger tankers. And there was this like shuttle service going on, and I'm thinking, okay, I don't have any interest in investing in this, but if that activity picks up, it's telling me maybe there's more platforms and there's not enough ships of that size or whatever, right? Like, you can always really dive deep, you can make speculation, but at the end of the day, it's only when you look into these things that you can realize what actually is happening. And one company is not going to tell you everything. You got to go into multiple things. But that's mainly what I use the tanker and the offshore drilling market for. It has not really appealed to me. I think there's a definite case in hindsight that people made a very strong case to invest in offshore drillers. I think that case still exists today, just because rig rates are only going to go higher. And deep water offshore is one of the only places in the world that can bring on that supply. And because the exploration success rates are so low, it means that we need more drilling in order to extract maybe the same volume of oil that could have been found 20 years ago or 40 years ago. So from that standpoint, I think it's looking really good. I also agree with your take that the ton miles are going to go up. That's literally a fact at this point. When Russia is sending its oil to India this way around, that it's a lot more miles than just going to Europe. Same with some of the other changes that are being made in terms of global crude and product supply. So that part of the market is going to go up. Is going to continue to go up. And as global crude and product demand goes up, that's going to obviously increase then more marine activity in transporting these things. So from that standpoint, I think things are looking really good. I don't follow the exact new builds versus scraps. So I'll maybe leave that if you want to comment on that. But I do think that one of the places where you can tell what's happening is the sanctioned tanker market, which seems to be getting really, really tight all of a sudden. And if the sanctioned market is getting tight, that tells you that there's no extra like excess ships floating around that can take over that market, which I think is a really good sign, given that those ships are, I think some of them are illegally over their year lifespan. So they are going to get scrapped. They are going to result in incidents and leaks, which means they have to be taken off. And one of the interesting things that happened recently was India just said they're not going to allow any ship over 15 years old onto their ports. So I'm not sure how this is being enforced quite yet, but more and more we're realizing with the ESG movement, you cannot have these spills and tanker accidents that are draining hundreds of thousands of barrels or well, not quite that much, but you're draining a lot of volume of possibly toxic products in the ocean water or seawater. You cannot have these in your waters. You can put it somewhere else and have it happen in Venezuela and Iran, but not off the coast of India or even China for that matter, possibly now.
Yeah, it's fascinating. I see shipping in tankers as like the girl that you know she's bad for you, you should stay away, but you end up saying, well, I'll just talk to her for a bit. I'll just
A little taste, yeah.
Anyhow, we will move on. The only type of company that you and I haven't really discussed would be the royalties. Now, there's some really good logic to the fact that, okay, we're expecting a higher inflationary environment. Level one thinking is, oh, I'm going to buy assets or asset producers because they go up. Not realizing that, yes, their top line revenues may go up, but there may be a commensurate or even more significant increase in their expense columns at some point. So what are your thoughts on royalty companies as a way of playing an increase in revenue without the commensurate increase in the expenses? Do you own any, or do you just back your advantage of knowing the ins and outs of the E&Ps, that you're happy that you've got a margin of safety, that they're going to have access to the upside without too much of an increase because they are more efficient wells, perhaps?
Yeah, great question. So from my perspective, when I look at royalty companies, I see a downside protection that people are wanting to take on oil price, that when you look at 2020 and what happened to the royalties in a call it a black swan event, doesn't exist. So the royalties got hammered just as much as the crude producers did. So a lot of people are saying, well, we like royalties because they're good down to $30 a barrel crude. I don't think that exists. That's maybe a misconception. Now, royalties do fare a lot better in these times where there's this chop between 80 and 70. Yes, they do fare a lot better. But at the same time, my question always comes back to the same question is, why would you want to deal with the volatility of oil with the minimal upside in royalties versus buying, something else in a different sector, maybe in the commodity space or in the manufacturing space, or a REIT, a real estate trust, or anything else, right? That has a very similar kind of pattern. Now, if oil goes to 120, 150, the royalties are going to make a lot more money without the increase in operating cost that you had mentioned. But the royalty might go up 50%, the producer might be up 4x. So you're giving up, you have very marginally higher downside protection, and you're giving up a lot of the upside is kind of how I think of it. The other thing that I see in Canada, especially, is that there are two companies, and I'm not sure if I should be mentioning names, but there are two companies that have really taken over the market in terms of what acreage they have access to. And I once again come back to undeveloped acreage. Both these companies have really, really good access to the undeveloped part of the Canadian conventional basins or unconventional. So as industry activity picks up, they're not only going to see higher royalties on their existing production, but their royalty volumes are going to increase as well. So there is definitely reasons why people buy these in their, call it registered accounts, the tax sheltered accounts. They want to leave these in there for multi years, which makes sense to me. But there's also one royalty company in Canada that is making very, very poor acquisitions. They're going into shale plays now and buying acreage there at very, very high premiums. So there's definitely a differentiation within the royalty game in Canada as well. So that's kind of what I run my thinking with. And the other way to think about royalties is kind of this way. Like, let's say there's a producer who has a producer that has a $15 to $20 operating cost, right? As we discussed. Now the price of crude goes from $60 a barrel to $80 to $100 a barrel. Even if your operating cost goes up 30% year over year, the price you're getting for the crude has gone up so much more in terms of dollar per barrel.
Expansion.
Yeah, not in terms of percentage, but in terms of the dollars extra you're getting, that it makes less of an impact. And you're absolutely right. The operating costs have gone up 10, 15, in some cases 20, 30, 40% just in the last year. But then I say, okay, crude has also gone up $30, $40 a barrel in that time frame. So I still see the torque being in the E&Ps, and I say this as somebody who lived through a 6-year cycle, 2015 to 2020, when oil prices, WTI, averaged less than $50 a barrel US. So given that I've gone through that environment and I see how royalties fare, I see how the E&Ps fare, what happens in a bull cycle, I think the only place that one can really make a case for the royalties is a very small royalty company that has specific exposure to a very high growth play. But other than that, I think if you're in the oil market, you're betting on higher pricing, I think the E&Ps have to be the way to go at this point in time, given that the royalties already trade at 10 times to 12 times free cash flow. So you're paying up for it and you're not seeing the upside as well.
And essentially, as you say, whether you realize it or not, you're betting on the same thesis, and which part of that curve do you want access to? And I think you nailed it. I think it's a perception of, oh, well, I just buy royalties and inflation because they just sit back and clip the ticket on this increased revenues. But if you're saying, well, I expect this thing to do well, why am I going to pay 10 times or 12 times for something with less operational leverage? Whereas I can come in at that lower end of that 1 to 3 times cash flows with all those value-added factors that we've spoken about. I think it's a very good answer. It makes a lot of sense. All right, let's move into some companies. We won't spend as much time as we did in the past, but there are 3 in particular I really want to get your take on. We've spoken about some of these. The first, I would love to talk about Surge Energy. What is happening with Surge? I'm personally very bullish, so disclosure. I'd love to get your take as to where they are now versus when we last spoke and what you see as their trajectory moving forward. Any sort of key comments?
Yeah, you betcha. So just before I get to that, one more point on the royalties. When people say, that you're too bullish, you're betting on this home run thesis all the time. I'm very happy with oil at 75, 80, and they're saying that the royalty company is going to do better in this chop environment. Perhaps, but the question I ask back to them, and maybe some of the viewers might be having this question, is if I gave you the opportunity that we just hedge oil at $75 for the next 10 years, would you take it? And a lot of them will say, no, we don't want this sort of thing. Like, we're betting on higher price, right? At some point down the road. And that's effectively what you're buying when you're buying an E&P. Especially now that they stopped hedging as much, is you're buying this upside. And I love the people on Twitter that are like, hey, we're making lots of money at 75, we're good, oil price can just stay here. And I ask them the same question, and you see them thinking like, no, I don't want to hedge my company. I don't want my company to hedge oil for the next 10 years at 75, right? So it obviously shows what the mentality of the average oil and gas investor is coming into the investments in the sector. So that's kind of that, and then we'll talk about Surge. Still remains my 1A, 1B holding. This is a name that has its spurts and it has its troughs. We saw throughout 2021 the stock did absolutely nothing. It was in this flat pattern. It actually went down in November, December of 2021, and then proceeded to go up 200% in the first 6 months. From December 24th to June 8th of 2022, the stock was up 200%. So why did that happen? Because these names are inherently tied to WTI price. When WTI is going to be 85, 90, 95, 100, that's when you're going to see these things move. And from my perspective, I get in early. I get in when the company's trading at multi like 20, 25% free cash flow yields. I also like when they trade at half or less of their 1P reserve value, because that's telling me the oil's in the ground oil as a commodity is not going anywhere in the next 2 or 3 or 5 years. But when you run an NPV 10 on an oil reserve that's 20, 30, 40 years, you effectively are only giving them credit for the first 4, 5, 6 years. After that, that 10% discount creates this curve where what ends up happening is every 12 months that go by, the reserve value actually increases because they have more reserve. Yeah, and as they're drilling, they create even more reserve. But at the same time, the company just generated 20 or 25% free cash flow in that 1 year, 12 months. That now comes back to you in the case of debt pay down, buybacks, dividends, new acquisitions, new drilling, production growth, etc. So that's why I think the higher for longer oil cycle, we need to have a different view on it, where it's not we're trying to make as much money in 2 years and then sell everything and move on. It's a cycle at this point. Given what happened in 2022, I think that the actions of the U.S. government itself in 2022 have extended the oil cycle for 2 to 3 to 4 years more than I would have guessed pre-SPR. So anyway, I'm digressing here a little bit. So I like Surge from that standpoint. It's still held up really, really well. The new wells in Sparky are doing great. The new wells in Southeast Saskatchewan are some of the best wells drilled in Southeast Saskatchewan. I know we talked about this before, and they spent $10 million on a land sale in Steelman late last year. That has now created 50 locations, each with an NPV, I'm guessing $3 to $4 million. So they turned 10 million into $200 million in the span of 6 months by drilling 2 or 3 or 4 good wells that have proved out the entire block. And that's what I want from these management teams is, now that the oil cycle is good, create value for me, whether it's through the drill bit, whether it's through buybacks, whether it's through acquisitions, create value for that dollar I'm putting into the company. The Enerplus acquisition has now closed. They're doing really good work on the water flood in Cadogan, as well as the other field they bought in Southeast Saskatchewan as well, Southwest, Southern Saskatchewan, let's say. And these are all optimization fields. Enerplus, this was not core to Enerplus. They wanted to be in the Bakken. They wanted to be in the Marcellus. They didn't want to be in Canada. So the fields just declined. They were mismanaged. They were not really well capitalized. So now that it's in the hands of Surge, which has proven and executed to me over the last, I've had Surge now for almost 18 to 20 months at this point as my 1A, 1B position, along with my biggest holding in my personal portfolio as well. So all I got to have them do is continue to execute and then let the oil price do the rest of the forking on that. And not much else going on there. I would expect them to continue to make bolt-on acquisitions here, which I've let them know that I agree with and I support for sure. So
acquisitions of existing producers, or buying those assets and taking them under the umbrella of Surge.
Yeah, so Surge buying other smaller producers in their area, doing more land acquisitions, creating value for the shareholder. I think, think about it this way: when you're buying another company at 2 to 3 times cash flow, and we expect multiples. Well, let me rephrase: you're buying companies at 2 to 3 times cash flow at 80 WTI, where what we're betting on is 7 to 8 times cash flow at 100 plus WTI. Now the torque just makes so much sense as to why they're doing these acquisitions. So I run with that. I'm going to give them time. In the meantime, it's not like they've been sitting on their hands and just saying, "Oh, we're just waiting for WTI to go up." No, they've been creating value for my dollar. And what else can I ask for? From them at this point.
Absolutely no, and you weren't digressing. You were just beating me to our next questions. I don't know how you do it, but you do such a good job. The notion of debt and the idea of hedging in, a lot of the times hedging will be a requirement to get capital and get finance. It'll be a covenant. But since we've had this high oil price over the last year or two, a lot of these companies' balance sheets look so much better than where they were. And so it speaks to that point. Well, we don't need to be quite as defensive in terms of hedging our commodity prices, because we no longer hold the debt, which I think is a big, I think, yeah, people just got this mentality from back in the day and realizing, well, hang on, every year a company looks different. What do things look like today into the future? So it was a great point. I've got to ask you about another one that I don't know why I'm just fascinated by this company, even though I'm a little bit scared as well. It's Saturn Oil. We've spoken about it before. So far, things are going okay. I want to get your comments on Saturn.
Yeah, you bet. I actually get a lot of questions on Saturn, given it really, I think, curates to the value investor mindset, given where it's trading. So I think last time that we had discussed, my comment was that if it continues to trade very, very cheap, despite my absolute hate of the way management runs the company, I would still look at possibly entering, and look at what they've done now. They have done this Ridgeback acquisition at an extremely nice multiple, very, very nice. They have bought a very high liquids play. Okay, it's not tier one creme de la creme asset, but they're buying it at such a cheap multiple with existing production, existing pipelines, facilities, infrastructure, everything. Ridgeback is one that I hold very near and dear to my heart, because the Ridgeback assets are the Lightstream assets, which went bankrupt in 2016 and was I believe my last bankruptcy I've had, but my most painful, given that I was catching the falling knife in 2016. They promised a lot. The assets were nice, dependable, low decline assets, and just 2016 was the worst brunt that the oil cycle took, and it took a lot of companies under. So now that there's a resurgence of these same assets in a pubco, it's kind of very, very interesting that they bought it cheap. They're also funding it with debt, which, as I said earlier, I like companies that aren't just diluting everything and saying, okay, we're going to issue equity at 2 times cash flow. Like it doesn't make sense. So because they're funding it with debt, yes, it's high interest debt. It's 15, 17, 18% debt, you betcha. And this is what's taken companies under in previous oil cycles. But once again, I don't run sub $70 oil in my models, because if I did, I'll just sell everything and move on if I thought that was a reasonable possibility of occurring. So I like the assets, I like the acquisition, I like the financial leverage on the company going forward. Not a fan of the management. I also think that the company might continue to empire build. So they bought this asset. Now they're 30,000 barrels per day or BOEs per day. 6 months down the road, they've got even more firepower to now go and acquire something even bigger. And you betcha it's going to be funded with debt, but there's going to be this equity component, which if you follow their history, they've been diluting equity at lower and lower pricing. I don't think that's going to continue, but you're still going to see dilution. I like the fact they didn't put out any warrants on this acquisition. So they are moving into a better cost of capital, call it, environment. And guess what? A lot of the pre-existing warrants might expire worthless in June 2023. So there's a large block, actually 2 large blocks of these warrants. If they expire worthless, your fully diluted share count, I believe, is going to drop something like 10, 15, 20%. Yes, the company doesn't get the money from the warrants, but do I really want to dilute at $3.20? Probably not. So once that headwind is gone, there's a pretty interesting case that can be made that, hey, if this thing is trading at a depressed value in June, once those warrants expire, or they make a massive acquisition sometime in the summer that craters the stock price, at that point, the value investor has to take a look at this company. I believe some already are, which is why I'm getting so much interest, which is likely why you've been following it for so long, is that it's just such a diamond that's kind of sitting there with this like fog around it that people can't see what it is. But at the same time, the management continues to scuff up the diamond as well. So there's kind of a double or a polarizing view on that. So I've always kind of said that this is a dynamic cycle to begin with, and with that, my own views are changing. I used to not care about management quality at all. If I can get something cheap, Then I got burned on one or two of my private placements that I did. And I really started focusing on the rock and the management executing on those. But as I look forward, I say, okay, well, if 6 months down the road, there's a company with poor management that's trading at a third versus its peers, you have to look at it. Even if it's not a long-term investment, you have to look at those companies and perhaps have an entry point, right? Like these, I would never tell anybody in my friends and family group, or anybody else for that matter, that hey, I'm investing in Saturn, because I've been publicly bashing the company for so long that it would make me look stupid. So it would be something I buy as a trade, possibly take advantage of something, let the share price revalue, make my penny on it, or nickel or dime, and then just sell it and kind of move on, because there's always inherent risk with these types of companies that they go and do more acquisitions. And the way that I can compare it to is look at Crescent Point Energy from 2010 to 2014. The company grew massively, their production grew, they were in a $100 oil cycle, and the stock did nothing in those 4 to 5 year cycle because it kept acquiring, because they kept buying. The one caveat is Crescent Point was buying at 10 to 12 times cash flow. Saturn is buying at 2 to 3 times. So this cycle is different, is much, much different than one we've ever seen before. And I'll say that, publicly. And, I guess we'll see how it all plays out. But it has reduced the downside risk a lot compared to the previous, call it 5-year bull run in the 2010s.
The pure arithmetic is simply different. There's no denying that. And I think, yeah, we've all been there. I'm looking at a coal company that may or may not be filing for bankruptcy quite soon. It's always nicer to buy after the bankruptcy, where you get this, Trader Ferg calls this subsidized asymmetry. The previous shareholders take a bath and you get to come in with a clean balance sheet. But yes, Saturn to me is, I look at the income statement and potential and I smile, and then I look at the balance sheet and I have a heart attack. So it's kind of between those two. Super important point about dilution. I'm okay with companies diluting when they're trading at high multiples and making intelligent acquisitions. I think it's the way to go. One company that's done reasonably well is Journey Energy. If we can get a 2-minute update on whether you still own a Journey Energy and whether you like what Alex, the CEO, is doing at the moment. To me, he's executing quite well. I'd be interested to hear your thoughts.
Yeah, you bet. So I don't have Journey in my portfolio anymore. It was very similarly tracking some of the other names that I have as my larger positions. So I said, okay, I'm just going to move into the larger entity and kind of stay there. At the same time, one of my other investments has the power generation business aspect of it as well. So I was covering it using 2 bases. I love the company. The management is the most in tune, one of the most in tune managements out there. Keep in mind, Alex himself has in the multi 8 figures, I believe, at this point of personal wealth into the company. And these are shares that he bought, not just shares that somebody gave to him as stockholder comp and whatnot. So love what they're doing. Nice, conventional, lower decline assets. The fact that they have optionality on oil or gas, 50% oil, 50% liquids, 50% gas. You get this optionality. Where do we want to spend the CapEx? Being a nimble, small company, they're also able to control. If things change very fast, they can adapt very fast, as opposed to a huge company that needs this layers of bureaucracy before they can change their capital budget or reallocate it. So doing very well from that standpoint. I haven't followed up with their latest well results, so something that I'm going to track and see how they're doing. I know they were looking at some new pools and looking at doing some development and optimization there. They also made a part of the Enerplus acquisition. So that acquisition, very similar to what Surge bought. There's differences always in assets, but a very ignored assets that were mismanaged, that didn't get capitalized. So now the team can come in and do that for them and bring production up. So nice little company. They've got the power gen. I think they're expanding that. I think the power gen is going to get valued at higher and higher multiples as time goes on, not just because the cost of building them is going higher, but because the Alberta pool electricity price is ramping up. yeah, it's about 50 to 100% higher than what these companies had projected when they built these power gen units. And keep in mind, Journey bought that power gen unit for about a fifth of its replacement value, if I'm not mistaken. So you already have this amazing internal rates of return that they got on that. So with that in mind, I think you have that part of the business. One other point I'll make on that is when you have a power gen business, you can pretty much borrow against that at a much better valuation and rate than you can against oil and gas properties. So companies that have power gen, even if they're carrying a bit more debt, just have a better capital stack structure around them. And one that I will stress that as companies do more of these, there's this general mentality that hey, this company's higher debt, so it's a higher bankruptcy risk. Like you can't just make general assumptions like that. Because the company has a power gen unit, it gets treated as an infrastructure, as a utility. And look at any utility company out there on the public markets, 10 to 15 times EBITDA is what they trade at. So there's a different valuation that goes into that. And I think if Journey continues to do these units, they will get the reward of that. And of course, as you know, very, very strong shareholder support with Journey to go through their acquisitions, continue making more acquisitions, continue growing the company. And it's nice to see companies like this in the Canadian oil patch. I'm almost amazed at this push that every single company must be a robotic dividend payer. Like that's not the way that we want the industry to go. Yeah, we want 80% of the companies there. We want companies that can grow production from a global supply standpoint to be in that, pay out everything to dividends, don't increase production. But there's these other companies on the side which make for very attractive investments that are growing production now or making acquisitions now with this expected return down the road, which is just insane. When you start running some of the modeling at valuations that could happen, valuations that did happen as early as 10 years ago, you start to see some really asymmetric risk reward there, which is really what gets me excited. Is that I've been patient for it's coming up to my 10-year anniversary on my first stock that I ever bought in oil. So I've been very, very patient. But if you go back to any oil cycle ever, when oil companies ramp, they ramp. There's no 20% gain. There's 200 to 500% gains that happen over the course of a cycle. And if you can compound those gains properly by getting into names and then reallocating and whatnot, there's no reason why you can't 100x your portfolio from the bottoms. And just to follow up on that point, just a little bit more, is that people say, well, the companies are already up 7x or 10x, but the cycle hasn't even started. We're only back right now where a traditional oil bull market would start in terms of valuations, in terms of where the oil supply demand is, in terms of where the oil price is. We're barely at the beginning of that. So this is one thing to keep in mind, is to differentiate the COVID recovery oil play from the structural bullish oil play that we have ahead of us.
It's a super important point, guys. Remember, the base effects were starting when we had a futures contract go negative. I mean, that's where we're coming from. So you got to kind of take that into the scheme of things in the bigger picture. You mentioned shareholders sort of throwing little tantrums about stamping their feet, saying, "I want my dividend right now." It's like, yeah, like we'll get you a lollipop, or you can wait until we go to the grocery store and we'll buy you like 10 lollipops. Like, just take that into consideration. I think it's an interesting phenomenon that I see starting to play out. And I see Synovus just came to mind today, because it sold off rapidly because they weren't going to meet their 4 billion debt target, and so they're not going to get 100% free cash flow going back into dividends, at least this quarter. So, well, there's more than one quarter to a year. Anyway, right. I'm going to throw some names at you, and I know that it's coming up on your time limit, so I'll throw some names at you, and if you do some rapid fire comments on these companies, and then I'd love for you to finish up talking about your private placements and some of the activist things that you've been doing. I'm going to start with Baytex. You talk about a run-up. So Baytex, PPR, Crew Energy, and potentially Sandridge. If you can rattle off maybe a comment or two on those companies, and then tell us about the interesting things that you're doing in the private space.
You betcha, yeah. So Baytex, Steady Eddie, doing really, really well. They have the P-Vine, of course, that is their flagship asset at this point. The well rates continue to absolutely blow things out of the water, like 600, 700, 800 barrel consecutive, consistent wells, really solid results. And the paybacks on them are not just one time. These wells will pay back 5-6 times in the first year at the right $90 to $100 oil environment. And they continue to pay out given their low decline nature. So really good. New CEO, new CFO. What's going to be the strategy going forward? They do have an Eagle Ford asset down in Texas. That's a joint venture with Marathon. Marathon just made a massive acquisition in the Eagle Ford, multi-billion-dollar acquisition. So what is the play there? We don't really know. I would like to see some more information on the management strategy. Given that management came from the shale play, I was not surprised to see this morning that Baytex is reapplying to be back on the New York Stock Exchange. I was guaranteed by investors that they're not going to do this ever again. They gave up the listing for a reason. Things are different in a $50 oil environment versus an $80+ oil environment. So we need to take things that they said in the past completely out of the equation. It's now what's going on going forward. So I was glad to see that. Along with that, Baytex has some really good heavy oil properties. So next to Obsidian, up there in the Peace River area, it's further delineation of multilateral wells. Loving that. And then the East Duvernay as well. They've got optionality. If they want to target it, they can. If they want to sell it, they can. If they want to delineate it, they can. So from a rock perspective, I'll put it this way. Baytex has the top quartile rock in each of the 4 to 5 core areas that they're in. So you're starting off with a really solid geologic base. The company has a lot of tax pools, and also their hedges have rolled off. So they had some pretty poor hedging even in 2022. Now that that's rolled off, it kind of gives the company more torque to the upside. Obviously, more torque upside or downside, depending on how you want to see that and run your models. The other one you said was PPR. I unfortunately cannot speak to PPR. I'm under a confidentiality agreement right now at the moment, but I hope to update everybody shortly as to kind of what's happening there. I know it's a name that I believe we had discussed last time as well. So I do hope that I'm off that restriction here shortly and can share a bit more. Crew Energy doing really well. They had their 2-year plan that they executed fantastic on. Now they've got a 4-year plan. So they have this plan all the way out, and they're saying we're going to increase production. We are going to delineate more reserves. They have some very cool wells coming online as we speak. There's a 5 to 6 well program in Tower, which is the eastern part of their acreage. It is kind of capped as a oil-rich acreage compared to some of their other acreage, which is still oil-rich, condensate-rich, but the Tower is just a completely more liquidy acreage. So what does it do? It gives them more oil production. It gives them more condensate production. Condensate is now trading at $3 to $5 above WTI. So just keep that in mind when you're comparing that oil to other kinds of oil in the Canadian basin.
And or I've seen, sorry to cut you off, but I've seen Baytex as one of them. They tend to be moving from lighter to more heavy production. Is that the reason why?
So when you move from lighter to heavier production, you get better netbacks when oil prices go higher, because the operating cost of heavy oil is higher, and because you get less money compared to WTI. When oil prices run up, you get a higher percentage increase in your netback versus a lighter barrel, like a shale barrel, for example. So that's why heavy oil gets really economic above $80, $90, $100 a barrel. Really wildly economic, because they still have tier 1 acreage in heavy oil, given the way the cycle has gone. Whereas in the lighter oil, you might be getting into the tier 2, tier 3 acreage, again, as we see in the case of Permian shales. So that's what makes heavy oil really economic. If you look at my holdings, you'll see there's a heavy oil skew to them for sure, for that exact reason. So definitely one thing to keep in mind. So Back to crude, the tower as well opens them up to M&A opportunities. They recently sold a land package in Attach or Altarez, I believe, $130 million with almost no reserves associated and zero production. So if they can sell that for 130 million, now they have land that they're delineating and proving really, really good wells on. It kind of differentiates the company's core areas. As well as that, they've got a well in Manaus, northwest, that has delineated a further ultra condensate rich area, UCR area. So they're just doing the job that we have kind of put them up to. These companies are trading at very, very cheap multiples from a currently reserves number, like a current reserves multiple. And then you take into account that they barely delineated 10-20% of their land base, which is all, as I mentioned earlier, in the Montney trend. So just because they haven't drilled there doesn't mean there's no oil there. We know there's oil based on geologic mapping, based on heat studies, based on seismic data, based on other coring and older wells. We know there's a Montney there. There's just no wells drilled in the Montney, which allow you then to create reserves of that. So I see a lot of development upside. They're also building a gas plant, which is really interesting to me because as things go on, I think the facilities value is going to get reflected in these stocks. These are multi-$100 million gas plants that nobody takes into the valuations of these producers. So as time goes on, that's going to be reflected, and companies that have a lot of pipelines and facilities and compressors, it's going to come back into the value of the company. So longer story, would I want crude to get bought out right now? Yeah, possibly. But do I think they're going to get bought out at a really good price? No, I don't think the buyers right now want to pay it. And I don't think the seller is going to sell. Like, crude management is not distressed. They know what value they have. They've worked on the company for, I think, almost a decade now. Plus, Crew actually came out of Baytex, so I'm not sure how many viewers knew this, but Crew Energy was a spin-off from Baytex of the gas assets, which has now grown to what it is. So, still a core holding of mine. I did reduce my percentage of Crew just because the private placement came in, and now that became my 1C holding. I don't want 4 holdings that are my 1A, 1B, 1C, 1D. So it did get reduced because I think it's a longer term time frame on Crew as they delineate these things. And then LNG Canada coming online will be a real catalyst for increased kind of activity in the basin. One thing to keep in mind, the Blueberry River First Nation decision that happened, it was blocking out a lot of Northeast BC development drilling. That's now gone through. But because it's gone through, a large part of some of the LNG Canada participants have had their land taken away. So they can no longer drill and develop on those lands, meaning they need to find more acreage. And guess what? Crew's acreage is almost 100% outside the Blueberry River affected area. Makes it a very attractive M&A target. And people ask, well, you've been saying this for a while. How come it hasn't got bought out yet? It's because management is not going to sell for a 50% premium. They're not going to even probably sell for 100% premium. They want the true value of the company to be reflected on a buyout. And if that value doesn't come, they'll just wait. Why rush a sales process by any means? So it's going to be more of a longer term position. They've got tax pools and they've got the sort of management and board that is, I believe, the top management and board in the Montney area. So very happy with how things are going there. Obviously, the lower gas price has brought the share price down. I'll leave it to each individual how they want to see that going forward. So that's that one. And then Sandridge, I unfortunately don't have really all that much information on Sandridge, but I will say this. Sandridge sounds like it's a very similar company to what I invest in the Canadian space, where I look for under-optimized wells. I look for wells that haven't been producing for a while. A company can come in, bring production back on those wells, get them economic again, and then produce out of them on a well that's already drilled, it's already completed, It already has pipelines. It's already there, right? So I believe Standard is running a very similar strategy. Very little bankruptcy risk. I don't think I need to say that to the shareholders. They've got what half their market cap in net cash or some that they have at this. Yeah, that they have at this point. So I guess the question becomes, what are they doing with that cash? Because if you're running an 8 times free cash flow multiple, which is sort of where I think things are going, you're never going to get 8 times on cash. So you have to do something with that money. So yeah, we'll see how they do going along. But you know, I would be very careful in today's market calling companies trash, calling companies that they are junk and whatnot. There are companies that I personally don't agree with their mandate. I don't like management, yes, but they still trade at 20, 30, 40% free cash flow yields at an $80 oil environment when we're all betting on much higher. So, you know, I think just be very careful. One statistic to back that up is in 2014, 2013, 2012, we had about 700 companies in the Canadian oil and gas space. We now have 150. So it's the strongest of the strongest of the strongest that survived an 8-year horrendous bear cycle where oil prices were in certain cases below the cost of sort of full cycle production, which took many companies under. At the same time, the companies that remain, not only are they the ones that survive, they have a lot of assets that are underdeveloped or undercapitalized. So as they bring those online in a higher oil price environment, I think when I go on some of my Twitter posts, I go hashtag bullish AF. There's a reason for that, that I put that on there so confidently over a mid to long term period, obviously.
Well, absolutely. Make another good point. And to wrap up, you're getting more and more active the more I listen to you in terms of some of the investments you're involved in. Maybe give a closing statement on some of your private placements that you've been doing and some of the more activist shareholder investments that you're currently in the midst of.
Sure, yeah, you bet. So this is maybe a bit of context if I can here. So late last year, September, October, November, I saw the SPR and what it did very effectively. I also saw that while the SPR brought oil prices down, it also brought supply down, meaning the US rig count started dropping. I started hearing about projects getting delayed or canceled. I started hearing about places like Suriname, for example. They didn't want FID any projects until they had more clarity on both geology and on the oil price. So there was a definite impact to supply. And guess what? In an undersupplied oil structural bull market, the only thing that can solve it is more supply. And if we're impacting supply to this point, where now it's not just oil price that people will be looking for to bring more investment into supply, they will look for stability. And we don't see the stability right now in oil markets. It's not even close to stable. And we're still below the $80, $85, $90 mark where people start to think about investments. So given that I was seeing this, I now see another at least 6 months before any sort of meaningful a supply investment starts to come into the conversation, after which there's a 3 to 7 year cycle before that supply actually comes online. I just saw the cycle getting extended higher and getting extended longer. At the same time, the people that were saying oil demand is going to drop have been completely wrong. Oil demand has not dropped, despite the Fed doing their very best to increase interest rates, hamper demand. They may have done that in certain parts of the economy, but definitely not in oil demand. And now we go into 2023 with Russia, or with Russia losing production, China growing demand, and the rest of the world as well kind of reopening. So I saw all this happening October, November, December. I was tracking the crude imports into China, which was the early sign as to what was going to happen there. And I said, okay, you know what? Let's adjust our portfolio strategy a little bit. I had built long-term connections with about 3 companies that I have on my target list, where not only do I want to come into them in terms of allocating capital, I want to bring them money. I want to have a larger stake in the company, which then allows me to not only take advantage of the cycle, it allows me to get a better price on the placement that we're doing because capital is so tight in these markets. And also, I come in with myself, with 2 petroleum engineers behind me, and a whole business development team and contacts as well. So we come to these small junior companies and we say, look, we want a bigger stake here. We don't want to dictate what you're doing, but we can help you out on engineering, geology, geophysics, business development, oil sales, marketing, all these things completely pro bono. We don't take a single dollar. I did not take any broker warrants or any sort of compensation on the placement. So we do these things because the share price is the reward. As we help the company grow, the company is getting more capital to develop their properties, and we come in and help them on some of the technical stuff. And hey, these companies are, as I said, they've got the production, they've got the rock, and you're buying them at such cheap valuations that it's basically just upside with very limited downside. So anyway, I'm digressing here. So that's kind of the mindset that I came up with. The first company we ended up doing this with successfully was Prospera Energy. It's all public information now. The news release was announced at the end of January, where we participated as lead investor and also negotiated for my group. We also have a goal of minimizing dilution. So compared to some of the other private placements that were done, I only raise or invest enough money such that we have a big enough stake where when we help the company out with these engineering and other business development initiatives, we are generating a big share price appreciation for us that makes sense in dollar amounts. So that's kind of where we are with that. Really focusing on companies with good rock, with good technical expertise, and allocating the capital. Putting my money where my mouth is, because the opportunities are in my opinion so good. Not all of them are good. I've said this before. I invest in one private placement and I say no to 25, 30, 40 of them for that. Once again, people think it's this 0 or 1 mentality where I'm just punting on names. I can guarantee you that's not the case. If I was, you would see me doing a private placement every 3rd day because of the kinds of things that come on the desk, I guess. So yeah, this will be my strategy going forward. I still want to maintain my top 5 sort of holdings on the public markets that are already there. And we're just going to shift the strategy a little bit as time goes on. And yeah, I don't want to talk too much about the name, but I did a couple interviews on this name discussing kind of my view and mindset on it that are also on YouTube. But yeah, really, really looking forward to the cycle. I'll put it this way. This is an engineers and geologists cycle. And I'm not trying to pat myself on the back. I'm saying this for 2 reasons. The first one is oil is getting harder to find. It's getting really difficult to find oil, explore for oil, develop oil. The expertise isn't there to develop 100 million barrels, to sustain 100 million barrels of oil per day and develop and create new resource for the decades ahead in both oil and gas. So from that perspective, it's much easier to understand where the cycle is going if you treat it as a kind of geologic cycle as opposed to a financial-based cycle. And the second reason why I say this is because when we look at these junior private placements, we look for companies that are differentiating themselves. You really need a technical background to understand what's happening. Companies will lie to you straight to your face. They will make up random nonsense. They will say they got this much reserves, and then you find out the reserves have a break-even cost of $200 a barrel, or you find out that the reserve they supposedly have has a 40% overriding royalty on it, or just some bizarre things that it's not that they're completely fraudulent, but they don't tell you the data.
Maybe fail to mention lots of details.
Yeah. So it's not that they're fraudulent, it's that they don't tell you things that you don't ask. And I think as an engineer or a geologist, you definitely have an edge in terms of figuring out the BS from the money makers. And that's really what differentiates investment performance is if you invest in one thing that goes up multi-100%, but you have 3 or 4 zeros with it, versus somebody who only invests in those that go up 100%, 200, 300, 400%, the performance difference is just wildly different. And not saying that I'm going to win on every trade, I'm going to be the one or anything, but that's the mentality that I run with. And yeah, the cycle and the world has given me this opportunity, so it's my right, and I think my service to take it to the best of its extent.
100%. I couldn't agree with that sentiment anymore. And I'd love to catch up with you a few months down the track and see how it's all planning out. We maybe have a discussion purely around that side of things. But thank you very much for joining me again. Pleasure as always. Ladies and gentlemen, Shubham Garg, White Tundra Investments. Do make sure you follow him on Twitter. All of his details will be in the description. And if you like the discussion, guys, feel free to share and drop us a thumbs up. Subscribe to the channel. Otherwise, take care, guys. Look forward to catching up with you with another episode of the ROI podcast later on. Take care.